Welcome to our deep dive into the legal ways rich people pay less tax. Today we'll explore how high net worth individuals use smart strategies to minimize their tax bills, all within the boundaries of the law. From clever deductions to sophisticated investments, these methods are often misunderstood or overlooked by the general public. By understanding these approaches, you'll gain insight into the financial world of the wealthy and learn how the tax code is designed to reward certain behavior. Let's begin by setting the stage for why tax planning is so important for those with substantial assets. Tax planning is crucial for the rich because their income sources are often more complex than those of average earners. They may have investments, businesses, and properties, each with unique tax implications. By proactively managing these assets, wealthy individuals can legally reduce their taxable income and preserve more wealth. This scene will highlight the importance of understanding tax laws and how strategic planning can make a significant difference in one's financial future. Let's look at the first major strategy, deductions. One of the most common ways rich people pay less tax is by maximizing deductions. These can include business expenses, charitable donations, mortgage interest, and even certain medical costs. By carefully tracking and documenting these deductions, wealthy individuals can significantly lower their taxable income. This practice is perfectly legal and encouraged by the tax code, which is designed to incentivize specific behaviors like philanthropy and investment. Next, we'll explore how charitable giving plays a role. Charitable giving is not just about generosity, it's also a powerful tax strategy. When wealthy individuals donate to qualified charities, they can deduct the value of their contributions from their taxable income. This reduces their tax bill while supporting causes they care about. Some even establish their own foundations, which offer additional tax benefits and control over how funds are used. Let's move on to another key tactic, investment income. Rich people often earn income from investments, which is taxed differently than regular wages. Capital gains or profits from selling assets like stocks or real estate are usually taxed at lower rates. By holding investments for longer periods, they qualify for long-term capital gains rates, which can be much lower than ordinary income tax. This strategy allows the wealthy to grow their assets while minimizing their tax liability. Next, let's discuss tax-deferred accounts. Tax-deferred accounts, such as retirement plans and certain investment vehicles, allow wealthy individuals to postpone paying taxes on their earnings. By contributing to these accounts, they can reduce their current taxable income and let their investments grow tax-free until withdrawal. This approach not only saves money in the short term but also allows for compounding growth over time. Let's see how real estate plays into tax saving. Real estate offers several tax advantages for the wealthy. Through depreciation, property owners can deduct a portion of the value of their buildings each year, even if the property appreciates in market value. Additionally, certain expenses like repairs and mortgage interest can be deducted. Real estate investments also allow for tax-deferred exchanges, enabling investors to swap properties without immediate tax consequences. Next, we'll look at business ownership. Owning a business opens up a world of tax-saving opportunities. Wealthy individuals can deduct a wide range of expenses, from salaries to office supplies and even travel costs. They may also structure their businesses to take advantage of lower corporate tax rates or pass-through taxation, which can reduce their overall tax burden. By reinvesting profits and leveraging tax credits, business owners can legally minimize their taxes. Let's explore tax credits next. Tax credits are direct reductions in the amount of tax owed, and the wealthy often take full advantage of them. Credits can be earned for activities like investing in renewable energy, hiring certain employees, or conducting research and development. Unlike deductions, which reduce taxable income, credits reduce the actual tax bill dollar for dollar. This makes them extremely valuable for those looking to save. Next, let's discuss estate planning. Estate planning is essential for preserving wealth across generations. Rich people use trusts, gifts, and other legal structures to minimize estate taxes and ensure their assets are passed on efficiently. By gifting assets during their lifetime or setting up irrevocable trusts, they can reduce the taxable value of their estate. This scene will highlight how careful planning can protect family wealth and avoid unnecessary taxes. Next, let's look at trusts in detail. Trusts are legal entities that hold assets for beneficiaries. By placing assets in a trust, wealthy individuals can control how their wealth is distributed and reduce estate taxes. There are many types of trusts, each with unique benefits, such as irrevocable trusts that remove assets from the taxable estate. Trusts also offer privacy and protection from creditors. Let's move on to another strategy, income splitting. Income splitting involves distributing income among family members in lower tax brackets. This can be done through family businesses, trusts, or investments. By shifting income to those who pay less tax, the overall family tax bill is reduced. This strategy is legal and commonly used by wealthy families to maximize after-tax wealth. Next, let's discuss offshore accounts. Offshore accounts are often associated with secrecy, but they can be used legally for tax planning. By holding assets in countries with favorable tax laws, wealthy individuals can reduce their tax liability. However, strict reporting requirements must be followed to stay within the law. Offshore accounts also offer asset protection and diversification benefits. Let's look at tax loss harvesting next. Tax loss harvesting is a strategy where investors sell losing investments to offset gains from profitable ones. This reduces their taxable income and allows them to reinvest in similar assets. Wealthy individuals use this tactic to manage their portfolios and minimize taxes on investment gains. It's a smart way to turn losses into tax savings. Next, let's discuss deferred compensation. Deferred compensation plans allow wealthy individuals to postpone receiving income until a later date, often when they are in a lower tax bracket. This can include bonuses, stock options, or retirement benefits. By deferring income, they reduce their current tax bill and potentially pay less tax in the future. Let's move on to municipal bonds. Municipal bonds are issued by local governments and offer tax-free interest income. Wealthy investors buy these bonds to earn income without paying federal taxes and sometimes state taxes as well. This makes municipal bonds an attractive option for those looking to preserve wealth and avoid high tax rates. Next, let's discuss tax-efficient investing. Tax-efficient investing involves choosing assets and strategies that minimize taxes. This can include index funds, ETFs, and tax-managed portfolios. Wealthy individuals work with advisors to structure their investments for maximum after-tax returns. By focusing on tax efficiency, they keep more of their earnings and grow their wealth faster. Let's look at retirement accounts next. Retirement accounts like IRAs and 401(k)s offer tax advantages for the wealthy. Contributions are often tax-deductible and earnings grow tax-free or tax-deferred. By maximizing contributions to these accounts, rich people reduce their current taxable income and build a nest egg for the future. This scene will highlight how retirement planning is a cornerstone of tax strategy. Next, let's discuss gifting strategy. Gifting assets to family members is another legal way to reduce taxes. The wealthy use annual gift exclusions and lifetime exemptions to transfer wealth without triggering gift taxes. By spreading gifts over time, they can move significant assets out of their estate and lower future tax bills. Let's move on to insurance products. Certain insurance products like whole life policies offer tax benefits. Wealthy individuals use these policies to grow cash value tax-free and pass on assets to heirs without estate taxes. Insurance can also provide liquidity for paying taxes or settling estates. Next, let's discuss tax residency. Tax residency determines where an individual is taxed. Wealthy people may change their residency to states or countries with lower tax rates. By relocating, they can legally reduce their tax burden. This strategy requires careful planning to comply with legal requirements and avoid penalties. Let's look at legal entity structures next. Creating legal entities such as LLCs or corporations allows the wealthy to manage income and expenses more efficiently. These structures offer liability protection and can provide tax advantages such as lower rates or special deductions. By choosing the right entity, rich people optimize their tax situation. Next, let's discuss tax advisors. Tax advisors are essential for navigating complex tax laws. Wealthy individuals hire experts to identify opportunities, ensure compliance, and develop custom strategies. Advisors help clients stay ahead of changes in tax legislation and avoid costly mistakes. Let's look at international tax planning next. International tax planning involves managing assets and income across borders. Wealthy individuals may invest in foreign markets or set up international businesses to take advantage of lower taxes. This requires careful coordination to comply with both domestic and foreign laws. Next, let's discuss tax audits. Tax audits can be stressful, but wealthy individuals are often prepared. They keep meticulous records and work with advisors to respond quickly and accurately. By staying organized and proactive, they minimize the risk of penalties and ensure their strategies are legal. Let's look at tax law changes next. Tax laws are constantly evolving. The wealthy stay informed and adapt their strategies to new regulations. This may involve restructuring assets, changing investments, or updating estate plans. By remaining flexible, they continue to optimize their tax savings. Next, let's discuss the importance of compliance. Compliance is key to legal tax savings. Wealthy individuals follow the rules and document their strategies to avoid penalties. By working with professionals and maintaining transparency, they ensure their tax planning is above board. Let's look at the role of technology next. Technology plays a growing role in tax planning. Wealthy individuals use software to track expenses, manage investments, and stay compliant. Advanced tools help identify opportunities and streamline reporting. By leveraging technology, they make tax planning more efficient and effective. Next, let's discuss the ethical considerations. While these strategies are legal, ethical considerations matter. Wealthy individuals must balance tax savings with social responsibility. By supporting charitable causes and complying with laws, they contribute to society while preserving wealth. Ethical tax planning ensures long-term success and reputation. Let's summarize the key points. Summary: rich people use a variety of legal strategies to pay less tax. From deductions and credits to trusts and technology, these methods require careful planning and professional guidance. By understanding the tax code and staying compliant, the wealthy preserve their assets and build lasting wealth. Whether you're looking to apply these strategies or simply gain insight, knowledge is power. Thank you for joining us on this journey through the world of legal tax saving.